Welcome to our tutorial series on the Executive Compensation 457B Plan for Tax-Exempt Cooperatives, presented by the Homestead Fund's Deferred Compensation Consulting Team. In this session, we will walk you through enrolling participants in your plan, including setting eligibility criteria for the plan and educating eligible participants about their new employee benefit. We'll also review the 3 key forms to be completed by the participant to accomplish plan enrollment. And finally, we will again highlight the key related resources available on the Homestead website. The first step in enrolling participants is to determine who is actually eligible to participate. As you may have heard earlier, the participants must belong to a select group of management or be highly compensated employees who also play a role in the strategic and/or financial direction of the co-op. Typically, most co-ops will draw a line on their organizational chart to define eligible positions. Using the on-screen example, this hypothetical co-op with 100 employees allows for participation by 8 senior managers, those holding the title Vice President and above. A smaller co-op of, say, 35 employees would likely find it difficult to rationalize a group of this size and might identify only the CEO and 1 or 2 others. There's latitude for each plan sponsor to determine their participation methodology, but it's important to designate a select and small group. The compliance concern is that plan participation could be used to circumvent discrimination testing issues on the qualified side. The key is to have a documented basis for describing eligibility. Many co-ops choose to document eligibility in their employee handbook, in their HR policies, and/or the benefits procedures. As both the IRS and Department of Labor could audit your plan, having a transparent, documented eligibility process could make such a situation run smoothly. Once eligibility criteria have been established, it's time to notify eligible employees and educate them about the plan features and benefits. By adopting and offering your key employees a 457B plan, you are providing a supplemental tax advantage opportunity to save for retirement or other future goals, especially since most, if not all, participants have incomes well in excess of the IRS income caps for benefiting from the tax advantages of both traditional and Roth IRAs. Plan participants can choose to make the maximum annual contributions to both the 401k plan and the Executive Compensation 457B plans. And participants can stop contributing at any time as well. Since these funds represent deferred compensation and not retirement savings, it's important to know that there is never any 10% early withdrawal penalty. We often hear about employees who are initially offered the ability to participate in the plan but decline to join. The timing may not be right for them for a variety of reasons. However, it's important to provide periodic or annual reminders about the option to participate in these plans, as these participants' reasons for declining participation may have changed. Their kids may be out of college, they may have all the weddings that they're planning to throw paid for, and so this could lead to excess cash flow that they'd perhaps like to invest. These reminders can also serve to encourage participants to increase their annual contributions into their 401k plans as well. As we all know, the earlier you start saving, the better. To help educate your eligible plan participants, Homestead has created a participant guide that covers the key plan provisions. We suggest using it as a discussion guide, along with a copy of your co-op's Executive Compensation 457B plan document, to introduce the plan and explain its features and benefits. This allows participants to make an informed decision about whether to join the plan. Encourage eligible participants to review this information with their own financial and tax advisors as well before making any decisions. While non-qualified 457B plans are similar in some ways to qualified 401k plans, there are a few differences that are important to understand. The plan is essentially a contractual promise by the co-op to pay compensation that has been intentionally deferred by the participant to a later date, such as retirement or separation. It is not a retirement account held in a trust. As such, plan assets are held in the co-op's name and not in the participant's name. Assets remain under the co-op's control until paid and are subject to the demands of general creditors in the event of a co-op bankruptcy or insolvency. In that event, plan participants become unsecured general creditors. Finally, 457B plan distribution options are much less flexible than allowed in a qualified plan. Once distributions start, they cannot be changed. We will review this in greater detail in our distribution tutorial. As your co-op introduces the 457B plan to eligible participants, many will have questions. Homestead's Deferred Compensation Consulting Team is available to answer these questions, and as requested, we can also hold group virtual meetings via video or phone with participants and others to explain the plan. At plan enrollment, each participant should complete 3 important forms. The first form is the deferral election form, which indicates how much the participant wants to defer each year, expressed as either a percentage of income or a flat amount, up to the maximum amount annually. It must be completed and dated in the calendar month before contributions start. For example, if a participant wants to start making contributions in June, the initial deferral form must be completed and submitted no later than May 31st. Participant deferral elections may be modified at any time thereafter. But if a participant wishes to increase or decrease the amount of the deferral, they should then complete a new deferral form again in the month prior to which they wish the revised deferral amount to begin. Deferrals for participant contribution must be set up between the co-op's payroll system and Homestead. We cover this process in greater detail in the Establish Investment Accounts tutorial. The second participant form is the payment election form, which designates when, now or later, and how, lump sum or installments, the assets should be paid out at separation or retirement. While most participants don't know how they want to receive their money at a point that can be far in the future, providing an initial payment election preserves the option to finalize their election, depending on your plan document, as late as 30 days after separation. The initial election is really just a placeholder, as payment election forms can be changed at any time during employment. It can be modified as participants approach retirement and their cash flow needs and tax brackets become clearer. If an initial election is not on file prior to separation, distributions may be governed by the plan default payment option, which is an immediate single sum taxable payment. This option may not be desirable for the participant's tax situation, which is why we encourage all participants to have a payment election file on file at all times. In addition to having this form completed upon initial enrollment, it's a good idea to periodically request the participant review and update the form. Homestead provides your co-op a sample form that can be modified to fit your co-op's desired distribution options and administrative needs. For administrative reasons, for example, your co-op may wish to limit payments to a maximum of 5 or 10 years and/or to allow only for annual payments versus monthly or quarterly payments, which can be more time-consuming to administer. We will discuss this further in our distributions tutorial. The last form is the beneficiary election form. Unlike qualified retirement plans, 457B assets do not immediately default to a surviving spouse upon a participant's death. Without an executed beneficiary form on file, these assets will be subject to your local probate process. We recommend collecting this form up front with periodic reviews by the participant, especially in the event that something changes in their life, such as marriage, divorce, death of a spouse, or the death of a designated beneficiary. So let's recap. When a participant enters the plan, it is important to collect all 3 forms and maintain originals and copies in your co-op's plan files, either paper or electronic, or both. Be sure to set up a schedule to have your plan participants regularly review them and make changes as necessary. Many co-ops use the annual enrollment process for this purpose. While a participant is still employed, all of these forms can be changed or updated at any time, and the beneficiary form can even be modified if there are still funds in the account after separation. Now that you know a bit more about enrolling participants in your Executive Compensation 457B plan, we suggest that you once again visit homesteadfunds.com, where you can find the participant guide and the 3 key forms we discussed, as well as other information about the 457B plan. As you set up your administrative systems at your co-op to manage the 457B plan, we suggest that you review and customize the participant guide and each of the enrollment forms with your co-op's logo and/or letterhead. Think about your plan participants and your administrative capabilities, especially as you review the payment election form. Your co-op may wish to modify the parameters of the payment option in a way that meets both co-op and participant needs. And as always, feel free to be in touch with the Homestead Funds Deferred Compensation Consulting team as you have questions. Thanks for joining us to learn more about enrolling 457B plan participants, and see you next time.